Good morning, good afternoon, wherever you are in the world. My name is Wambui Chege, and I am the independent chair for Making Finance Work for Africa. And it's my pleasure to welcome you all to our annual General Assembly meetings 2020. I don't know about you, but 2020 has been a year like no other. In so many ways, it has felt surreal, really like a very bad dream that doesn't disappear or will not end. For many businesses, this has been a very, very tough year. I think for all of them, one of the toughest that they have ever had. And for Africa, these are also really, really troubling times. As a continent, we are looking at contracting GDP, with poverty expected to increase by 2%. According to the World Bank, about 26 million people in Africa will slide under poverty. Half of those are expected to come from just five African countries: Kenya, Ethiopia, South Africa, DRC, and Nigeria. Governments have taken strong measures to respond to the crisis, taking a variety of fiscal, monetary, and financial sector interventions, and we will hear about some of them in the sessions in this meeting and also the ones to come in the other sessions in the annual General Assembly. It's not all doom and gloom. More economies have moved towards digitization as people have been forced to embrace cashless economy. So there is a ray of hope somewhere. This series of meetings will explore the effectiveness of those interventions with a view to identifying opportunities and drawing lessons learned to support policymakers post-COVID. We have put together a wonderful group of speakers and panelists for all the discussions over the next 2 days. And we look forward to having fruitful discussions and guidance that will come out of these meetings, as well as call to actions. I'm going to hand over now to our coordinator, Abdelkader Ben Brahim, to host our first session for the day. Over to you, AK.
Thank you very much, Wambui, and hello, everybody. It is my great pleasure to welcome you all from Abidjan to the Making Finance Work for Africa Annual General Assembly, which this year we are hosting under the theme Financial Sector Development in the Era of COVID-19. My name is Abdelkader Ben Brahim, and I am the Partnership Coordinator for Making Finance Work for Africa. This is my first AGA as a coordinator. And this year, of course, our event is happening under unprecedented times due to the impacts of COVID-19. And as such, the event for the first time will be fully virtual. But perhaps the one positive thing really a few of them, but one of the positive things to take out of this year's event is that we're also for the first time opening up really the AGA to a wider audience. Usually these general meetings are restricted to our members, partners, and stakeholders. So we are really excited to welcome more of you today. We promise you a very engaging and stimulating discussions over the next 2 days. And what better way to kick off this AGA with this group of panelists to talk about the first topic of the day, responding to the pandemic, measuring the effectiveness of financial sector policy measures. But before I introduce the panel, allow me please to just first share with you some thoughts on what we would like to get out of this first session and also over the next couple of days. The focus, as the title suggests, will be to reflect on the role of financial sector development in the COVID recovery, but to also think beyond that and really, as the saying goes, never let the crisis to waste. So what this crisis really has emphasized is the need for radical and profound change in the African financial sector to make it fit for its main purpose, and which is really to better serve the real economy and the society, and also to support the transformational change that the African continent needs to make it a more resilient, carbon-free, and inclusive economy. And while we have seen some development progress in Africa over the years prior to COVID, there is now real danger that many of this progress might be reversed. And so thinking about how we can find ways to better and improve the financial sector to better serve the society will be our main focus for these next 2 days, but also as we move into the new strategic phase of the partnership, Making Finance Work for Africa. Yes, it's true. Africa remains the region with the least number of both COVID infections and deaths. However, most countries have and continue to face demand and supply shocks and have used fiscal stimulus or even financial sector interventions to cope with the economic fallout of COVID-19. And this is also further complicated by the fact that African countries have the fiscal space, have the limited fiscal space to implement any sort of stimulus packages that we have seen in other countries. And a lot of the adopted measures have been in the financial sector as well. Central banks have been very proactive in their response, not just in monetary easing, but also in regulatory forbearance and to try to encourage banks to continue to lend and encourage credit growth. And while a lot of these measures have been helpful, the longer this COVID crisis persists, the more it may complicate the counter-cyclical policy, particularly in debt-burdened countries. And there is a real existential risk that this economic shock becomes a financial shock, simply because there's a real risk of the amount of liquidity that many countries can generate, and the risk of outflows and the inability to generate foreign exchange needs and so forth. So we will reflect on these and more over the next couple of days with a strong focus on particular areas in the financial sector, such as banking regulation and supervision challenges, overcoming SME trade finance barriers, mobilizing institutional investor assets, and promoting a gender-sensitive economic recovery. So this is the background, and in the first session, we will try to take stock of all of this. And I'm most delighted to have an excellent cast of speakers today. So first, I would like to welcome Deputy Governor Elziado Awadzi, who is second Deputy Governor of the Bank of Ghana, and only the second woman to hold that position in the bank's 63-year history. She was recently appointed by His Excellency President Nana Akufo-Addo as one of the 7 trustees of the COVID-19 National Trust Fund to support those at the forefront of combating the disease. Deputy Governor Elzi is a legal, governance, and international finance professional with over 24 years of professional experience, previously at the IMF as the senior counsel, and also 2-term as the Commissioner of Ghana's Securities and Exchange Commission. So welcome, Deputy Governor. I would also like to welcome Deputy Governor Michael Atingiego, who is an economist and is Deputy Governor of the Bank of Uganda. He has previously served as the Executive Director of Research at the Bank of Uganda, also as the Deputy Director of the African Department at the IMF, and recently the Executive Director of the Macroeconomics and Financial Management Institute of Eastern and Southern Africa, MEFMI. Welcome, Deputy Governor. We're also happy to have with us today Ms. Isabel Lesegina, who is the Senior VP at TCX Fund, a global development finance initiative which offers long-term currency swaps and forwards in more than 100 financial markets. Prior to joining TCX, she held senior roles in infrastructure and asset finance at Phillips Capital, GE Capital, and other financial institutions where she originated and structured complex projects across Europe, Middle East, and Africa. But last but certainly not least, I'm also happy to welcome Ms. Judith Tyson, who is a specialist in financial market development, who works at the Overseas Development Institute, with more than 2 decades experience as an investment banker at JP Morgan and Deutsche Bank. She also spent 6 years at SOAS University of London, where she was a research assistant on the EU FESUD project on financialization and an adjunct professor. She has published books and articles on a wide variety of subjects in financial sector development in Africa. So welcome to you all. And I should also mention that we have more than 300 people that have pre-registered for this session, for the AGA, and from more than 40 countries. And we're also expecting a greater number to dial in. So We will have enough time towards the end for your questions. You can submit those questions either in the Q&A or in the chat features anytime during the session. So please be ready with your questions and contributions. Also, I'd like to let you know that we will have interpretation in French for our French audience. And that can be activated in your screen below by clicking on the interpretation button. Okay, so I'm gonna start first with you, Deputy Governor Elsie. Welcome. So as you think back over the past 9 months, could you perhaps share with us some initial thoughts and how you see the impact of the pandemic on Ghana and in the African continent generally? I know that the Bank of Ghana has been very active, and we have been following you and your work, but we'd very much like to hear your assessment and your articulation of the Bank of Ghana's response. Over to you.
Thank you so much, AK, and good morning to everyone. As you said in your earlier remarks, I mean, this pandemic erupted and suddenly happened upon all of us. And in Africa, the effects on the health sector have not been as severe as has been around the world, and touch wood, but we have seen a disproportionate impact on the economies of our countries in Africa. This has happened for a number of reasons. A lot of our economies are informal, largely informal, and therefore the necessary restrictions that had to be put in place to help contain the health crisis necessarily impacted the lives and livelihoods of many of our populations. And so you did find that people very suddenly were out of a job or were out of their informal sector businesses. And even formal sector businesses tend to be micro and small, very few medium, very few large. And so as a matter of course, a lot of these businesses have found it very difficult to cope with the impact, with the sudden shock of the pandemic. What is more, we went into the pandemic with very weak social safety nets, as a result of which it was very difficult to trigger responses that had already been well-designed, well-targeted to help the most vulnerable. So governments and central banks have responded, and in Ghana, the government responded with a lot of fiscal policy impetus, basically just to provide relief, very quick relief to those in the informal sector by way of cash handouts, by way of food, by way of all sorts of other interventions. The central bank also came out with a number of policy and regulatory measures, including a rate cut very early on, about 150 basis points, and then a slew of regulatory reliefs aimed at helping the banks themselves be able to provide relief to their customers, which was very key on our mind. So by releasing some capital and liquidity buffers to banks and other financial institutions we license and regulate, they were able to pass some of those benefits on very quickly to their clients by reducing lending rates, even on existing loans, by providing moratoria of up to 12 months to certain borrowers, and even by lending to borrowers that needed to be part of the response effort. For example, those in the pharmaceutical industries who suddenly were producing hand sanitizers, and medication and other things to fight the health crisis. What we have found is that, again, because you had very weak social safety nets to start with, these interventions were quick. Government provided some small business loans and grants and all of that, but it's not very clear that these were done, for example, in an inclusive manner, in a gender sensitive manner, in a way that, for example, address the already existing gender gap to access to finance, which is about 9% already, stacked against the women, stacked against the youth. And so in providing these small business loans and grants, for example, These were done on a gender neutral basis, on an age neutral basis, and you may find out that these have further pushed some of these vulnerable groups further out of the financial sector because they already were dealing with gaps in terms of access to finance. And so after the fact, and with very poor data starting out, one is beginning to review these measures. One is beginning to take a hard look at these measures to see what has worked, what hasn't worked, and what can be done going forward.
Thank you very much for these initial thoughts, and I will come back to you. You have mentioned some things that I would like to touch up on, especially applying a gender-sensitive approach and a gender lens to responses generally, and how would that look like from a monetary perspective. So I will now actually turn to Deputy Governor Michael. And Deputy Governor, you have taken the helm just as the crisis hit. The Bank of Uganda has also been very proactive in its approach in reducing interest rates and other measures to provide liquidity to financial institutions, to restructure also loans of corporates and individual customers. We would very much like to hear your reflections on this past few months on the COVID crisis and how the Bank of Uganda has been supporting the government's fiscal response. But also, as you talk about that, we'd also like to hear maybe some of the risks that you were particularly and still concerned about. Over to you, Deputy Governor.
Thank you very much, and I'm very humbled and honored to be a part of this panel. And I want to say a very good morning to all of you in Abidjan, and afternoon wherever the rest are. So let me begin my interventions without going through the similarities that Elsie has talked about. I will put my analysis in two perspectives. One, following the outbreak of this pandemic, there was a total lockdown in the economy as we were trying to see how do we deal with this animal here? How do we, because nobody knew exactly what it was about. Nobody knew its intensity. Nobody knew how long it was going to last. So there was a total lockdown as we were trying to prepare. And that lockdown came with several consequences, right? In that the chaps who were engaged in employment were affected in different levels. There were those who live hand to mouth, right? These are the small micro workers, and then there are those who live off agriculture and what have you. So the impact on those following the lockdown was quite substantial. And I will come back to that later on. Now, what happened was that economic activity kind of plummeted immediately, and unemployment shot up during the lockdown. But then we didn't have sufficient social safety nets to deal with that. So you find that those who are living hand to mouth were severely affected, right? We actually did a survey and found that 52% of the household and small farms, right, could not live beyond 1 day, right, on their incomes. So they had sufficient resources just to live for 1 day. And then 87% in totality could not go beyond 2 weeks, right? So they were badly affected. And where were they badly affected? Most of these guys are financially excluded, and the government didn't have sufficiently strong social safety nets. For those who are somewhat financially excluded, they were able to access either their savings or get some kind of overdraft from their banks or financial institutions to deal or to respond to this lockdown. So who were the culprits? The culprits were small households, small micro enterprises. So mainly the small micro and medium scale enterprises. So the response then was, how do we deal with these guys here? So if you look at the responses, it was mainly to support the real economy by having new credit extension, support to these households and the micro, small, medium enterprises. And then government had to come with innovative approaches to support the credit extension to these guys, because the formal financial sector could not deal with these chaps, right? Because of owing to the nature their business and capacity to access financing from the formal financial system. But at the same time, government was aware, right, that we are dealing with a pandemic whose duration and intensity we do not know. So how do we make sure that the financial stability is preserved? So it had to come in with sound credit management policies and then debt restructuring to minimize additional risk taking. So that was the key aspect of it. So during the lockdown, we were able to minimize the rate of infection, but at the same time, we were growing unemployment and lowering economic activity. The consequence was that inequality was going up and more people were falling into poverty reduction. Now, that then informed the discussion. How do we have a trade-off between opening up, all right, and ensuring that the infection rates do not overwhelm the capacity of the existing health system? So it had to be a gradual opening up that was calibrated, right, with the capacity of the health system to deal with the increasing number of cases of infection given the opening up, because in the opening up, you are minimizing aspects such as infections, the social operating procedures, the contacts were now increasing. So how do you deal that? At the same time, government was looking for resources, right, to deal with those who are vulnerable to this pandemic. You needed activity to pick up so that you can collect sufficient revenues, and also so that the financial institutions could get back to doing some business, and maybe some of the borrowers could also get back into some activities and begin repaying whatever obligations that they had to the central bank, to the commercial bank. So the consequence of opening up was that we saw a jump in the infection rate, all right? That now began to overwhelm the health sector. That was the bad side of it. But the good side of it was that we saw economic activity begin to pick up, government revenues begin to pick up, and employment activities begin to come in again, hence dealing with the inequality and the number of those who are getting back into poverty as a result of the lockdown. So there was that slippery, that trade-off between higher infection rates and ensuring that unemployment and inequality are kind of like are handled. Now, the measures that Elsie talked about were also adopted by a number of central banks, all right, in the region. But the downside about this was, whereas the aim of the central bank was to increase liquidity to the commercial banks to deal with the pandemic, to increase lending to the real economy, that was not the case, right? Why? Because commercial banks were risk averse. They all knew that, look, economic activity is not picking up. So why on earth would they be extending credit? If these guys are even asking for credit relief measures from me, why should I be giving you more credit? I don't know how this thing is going to evolve going forward. So the risk averseness by the commercial banks kind of like constrained how much they were going to lend. So the objective of the central bank to increase lending in the pandemic was kind of like constrained by the risk averseness adopted by the commercial banks. So it needed a totally new approach to deal with this. So that's when government had to directly now come in, all right, that how do we help the micro, small, medium enterprises? We sought some financial assistance from the IMF under the Rapid Credit Facility, and the substantial portion of it was used to finance certain development institutions, all right, to on-lend credit to medium, small, and micro enterprises. The central bank has a development wing called the Agricultural Credit Facility, which resources were also boosted for lending to agricultural areas. And then the commercial banks were dealing with the so-called safe customers even in the midst of the pandemic. There were some manufacturing firms that benefited from this pandemic, particularly those that were in the health sector. There were others that benefited, those who were supporting the mitigation measures of government. So all of us benefited, but credit per se did not pick up. it took additional intervention by government to ensure that that credit actually picked up, notwithstanding the efforts of the central bank to have liquidity available for on lending. So there was a gap somewhere that the risk averseness assessed by the commercial banks did not ensure that it happened. So we needed to look at that thing. So going forward, the issue then is, what do we do? And that is a fundamental question, which I think I will address later on in our discussion. Thank you.
Thank you very much, Deputy Governor, and you have addressed a lot of very important points and food for thought. Particularly, we're all keen to sort of understand the type of policy responses that would be appropriate for many of the African economies, given the fact that COVID-19 has disproportionately hit the bulk of people who have who earn semi-formal earnings, or where the bulk of their income come from the informal sector. So how to the channel, and how could the channel this response to reach those people? And you've mentioned the important approaches that the governments have taken. And yes, of course, I would like to later on pick your brain on maybe a forward-looking approach as this crisis persists. But before that, I would like to maybe go to Isabel. I would like to bring you to this discussion. Isabel, so the crisis has been unprecedented. We know that. It's the worst in the past 80 years. And this one particularly stands out because it is both primarily a health and a social crisis alongside an economic one. But if you look at it from an economic lens, you see a lot of the similar, I would say, symptoms that we have from previous crises, whether it's the financial crisis of 2008 or the commodity crisis. So things like capital flight or a drop in commodity prices. This time around, very early in March, when the crisis hit, we've seen a high degree of stress in global financial markets. And of course, this has resulted in unprecedented levels of quantitative easing. Could you perhaps share with us some thoughts in terms of what has been the impact on capital markets, both on global capital markets and also domestic African capital markets? And as you do that, do you see a situation where do you see a stabilization of the situation?
Thank you, AK. Good morning and afternoon, everybody. I hope that you're all safe and well. So to add to the point of the two former panelists, I think in March, everything kind of entered into a fever dream mode. We were expecting way worse than the 2008 crisis. We saw capital outflow of $80 billion, I think, according to the Institutional International Finance. We saw loss of revenue from countries. We saw loss of shortage, and there was a huge volatility in the market. All these elements kind of were accumulating: the health crisis, the financial crisis, the economic crisis. We saw currency shock, the debt sustainability issue. So on top of all the debt that the country had to reimburse, you added all the shortage of revenue in the future. You had the local currency shock that depreciated some currency by 20-30%, increasing the debt burden. We were at the height of this crisis. We as a fund that cover currency risk, we had our biggest loss in our history. And we only cover 1 or 2% of the offshore currency market. So we lost 130 million that month, which shows the size of what could happen if you're only 1 or 2%. And by doing so, we fulfill our purposes, which is to protect the small and medium-sized enterprises, the most vulnerable in frontier emerging markets. So we were, even though it was difficult, we were very proud of serving our mission in life. But as you look at it at the end of the day, now you see that Africa was the country that was the least impacted by COVID. So we can say it's different justification for that, but I think most of the government in Africa did a pretty good job at managing that. And we saw that central banks were very, very, very active to help keep the economy afloat and limited loan impairment. There was a huge fiscal and large monetary easing policy implemented. did all this liquidity provided to the sector, as Michael was mentioning, was reflected after in the real economy? I'm not sure, depending on the country, that all the banks, all the financial institutions played a role in that because of the worry on the credit side. And it's not only commercial banks. I think it was also DFI at the first stage that work a lot in restructuring existing loan, protecting their existing customer. And because of the whole height of the economy, couldn't do the due diligence necessary to onboard new financial institution. Even so, that said, I think they did a lot of job in providing countercyclical money to existing financial institutions, especially microfinance institutions. There was a lot of restructuring, a lot of fund provided to these microfinance institutions to be able to continue providing moratorium and lending to the most vulnerable. I think that plays a certain role at kind of limited the impact. However, I have to say, the interest rates are low now. And it seems that even though we're going to have a contracting of the GDP, African economy might pick up, but if the yields remain low, the capital outflow foreign investor might not come back, and capital outflow might continue. So I think it's going to be important to find a way to balance all these elements to make sure that capital come back, and that will come back mostly by starting by the DFI and the MDBs. They have to play their role in being countercyclical investors and providing guarantee and other measurement to help bringing financing back. And by government, central banks, and all the actor in the financial sector to work together to create a framework that will allow financial market deepening and a strong infrastructure to allow to the future to be a bit more structured. I think he was the VP of private sector AFDB at the conference. I think he took it from someone else, but I don't know. He said never waste a crisis. I think it's an opportunity now where in the future to do a kind of when the reset started to build a strong infrastructure so we don't go back again in 5, 6, 7 years with another crisis with debt moratorium and the same issue all over again, but try to do better as a continent for the future. Just to finalize, I think one of the elements also, despite that the situation economically, everything, the market is easing up and is getting slightly better, at least on the market side, always a bit disconnected from the real economy, to be honest. Indebtedness is still a key issue. Zambia defaulted for different reasons. They were already high in debt. The market were already worried about them, but they were expecting that the issue of their indebtedness will be only appearing in 2022. This crisis brought that way forward by a serious 2 years, and the depreciation of the currency brought it to a bigger, stronger impact. So we have to pay attention to the other countries. Is Zambia the first? I'm not sure. I think other countries, 4 or 5, are also in danger, and there's really have to be a big issue and discussion about debt sustainability because the macro level influence the macro influence the micro, and you have to make sure that government are be able to be sustainable and borrow in a more sustainable way to make sure that they protect the economy and make them more resilient in the future.
Thank you very much, Isabel. And you've raised an important point at the end about obviously the sovereign debt business, and of course the outlook of that is extremely poor in many countries, and we've seen a surge in yields in many markets. I think I'd like to touch up on that later on because I think the analysis on that, the latest I've seen on the IMF, pointed to probably refinancing risk of another 3-4 years or so. So this is something that we will certainly explore. But right now I'd like to move to Judith. Welcome to this panel. And so Judith, we've heard from the deputy governors and also from Isabel. And if you look across the board in Africa, we're seeing many similar attempts throughout to fight the pandemic with a focus on monetary easing. Lowering interest rates, also combined with the fiscal stimulus from governments. Could you perhaps share some of the lessons that we may draw from this present crisis, but also from the previous crises? And how do you think that would shape future policies?
Yeah, thank you very much, and thank you very much for the invitation to speak today and the remarks of the other speakers. I think it's very interesting actually to hear what the deputy governors have to say. Both Elsie and Mike highlighted, the responses, and as you comment, they're fairly typical of most of the central banks across the region. And in many ways, I think, where we stand today, they've been reasonably successful, particularly in, protecting people at the bottom of the pyramid and in the informal sector and in managing the health crisis. It's also interesting, I think, that Mike highlighted, the use of the IMF's Rapid Response Facility, which was a facility that was designed after the financial crisis in 2008. Where the IMF and the World Bank were heavily criticised for not being fast enough to provide liquidity, during financial crises or shocks of this type. So it's good to hear that worked more effectively on this occasion. It's certainly something we'd like to draw more lessons on. I think the real big issue, though, is what happens next. And Isabel highlighted the issue about the debt. And obviously what has happened as part of that response is that there's been significant increase in debt in a situation where the economic outlook is poor. And Mike highlighted that debt has largely been assumed by the government rather than commercial banks. But I think it would be likely to say that we would also expect there to be a worsening of the debt situation or the asset quality at commercial banks. And we are seeing rises in bad debts in the commercial sector. And what that really points to is a situation where unless there's a rapid recovery in the economy, which is probably possible but not the expected outlook, we will see a significant rise in bad debts, both in the public and in the private sector. And the question is, how do you manage that whilst not adding to the recessionary forces in terms of economic recovery? I think it's quite interesting in that regard to think of the experiences in other regions, particularly in Asia and following the financial crisis of 2007 and 2008, because there are essentially two paths. One is bad debts were recognised quite rapidly and written off. Now, the result of that is you've got a much sharper contraction in commercial lending. And, there was an absolute classic credit crunch. And in many cases, a more systemic crisis in the banking sector as a result. So obviously that's not a great option, but it's one of the options. But the other one that was taken by, probably most classically by Japan, but also in other places like Korea, was that there was significant forbearance on debt. But the trouble with that is it created what was known as zombie banks and zombie firms, which were effectively bankrupt. And were created a very long-term drag on economic recovery. And in fact, in the instance of Japan that I mentioned, their economy has never recovered. And the ability to write off and manage that bad debt problem was severely impaired as a result of those policy decisions. So there's not, I think the lessons is there's not great choices, but we do need to recognise and start thinking about how to manage the debt at the same time supporting economic recovery. Probably I'd also just comment on the international outlook as well. Obviously, even before the crisis, there were significant concerns across the region about debt sustainability in the public sector. The results of COVID is that the Eurobond market and international markets effectively closed to African names. I think we've had no issuances of Eurobonds since February. So that means the external debt situation, certainly in the private markets, is pretty poor. I think we need to be pressing perhaps for public responses and thinking about debt restructuring and further financing for African governments. Maybe I can end there and then we can talk a little bit about what policy we might wish to promote. Thank you.
Right, thank you very much, Judith. And we will certainly now move to the more forward-thinking, forward-looking segments of this question. May I just remind the audience to please feel free to submit your questions either through the Q&A or the chat feature. Deputy Governor Elsie, I'd like to go back to you now. And we've talked about some of these risks and issues that many countries are facing. Perhaps maybe you're coming into this crisis with two cards. One, of course, the bad card, which is perhaps the debt crisis. The good card, and I'd like you maybe to elaborate on that. And I know that the Bank of Ghana has taken a number of measures to strengthen the banking sector prior to COVID. You talked, of course, earlier about the measures that you have taken during the crisis to ensure banks continue to channel credit. Of course, the big question is, how long will this COVID crisis persist? And as you look to support the post-COVID recovery, what policies and instruments will be important to make sure that financial institutions are continued to be incentivized to serve the real sector? And of course, that would be coupled with the continuous fiscal response and hopefully other actions by the multilaterals on the debt issue. Over to you. I think you're on mute, Deputy Governor.
I'm sorry. So just before I look at the going forward issues, let me respond a little bit to something that both Isabel and Judith alluded to. This was comparing the current crisis, if you will, to the 2008 global financial crisis. I think there's a marked difference between the two, and it's actually very important for policy reasons. So whereas the global financial crisis was really a financial crisis that then translated very quickly into a fiscal crisis in some countries, like in Europe, right, because of extensive bailouts of the banking sector. This crisis has started as a health crisis and then impacted the real sector, and then only became a financial sector problem, right? Because the financial sector in many countries, at least speaking for Ghana, became the key anchor that was holding everything together. So you have a health crisis, you have a real sector crisis, and then you're dealing with the financial sector that's trying to hold things together. And you made mention, AK, about the fact that we had gone through a very painful 2-year cleanup of our financial system, where we had closed 420 banks and smaller financial institutions that were all insolvent, had been in zombie status for a few years. And then the Securities and Exchange Commission also embarked on a massive clean out of the fund management industry, closed about 50 odd fund management companies, And so going into the crisis, the financial sector was in a slightly better position to be the anchor, the key anchor holding things together, which meant that the policy and regulatory reliefs that we provided to them enabled them, equipped them to be able to translate that into reliefs for their customers, which then began to help with recovery efforts already. So even while we were thinking of containment and providing these reliefs to banks so that they could hold their clients together, that already was beginning to fuel early signs of recovery also. So the financial sector became the buffer. And that speaks, going forward, that speaks about the quality of regulation, the quality of supervision, and financial sector policy. Because going into the crisis, if we had not conducted the reforms that we had not undertaken the reforms, it would have been a really big problem. So that, for me, is the key difference between what's happening now in many countries and what happened in the global financial crisis. What we have found is that our financial sector, the banking sector here, largely, hasn't only been able to support their customers, particularly those at the bottom of a pyramid, by helping them restructure their loans and provide moratorium. Like I said, they've also provided new loans to the pharmaceutical industries and some of the key industries that have helped to deal with the health crisis, right? When we provided the reliefs to them, we were very quick in coming out with a directive to say, we know exactly how much liquidity this is going to translate into. We did the calculation, we did the math very quickly. Bank by bank, we know how much these reliefs are going to translate into, what kind of liquidity. We do not expect you to increase your holdings in government paper to make profits as a result of these reliefs. If you have funds from elsewhere that you want to increase your holdings in government paper, go ahead. But for these sums of money that have been released through our regulatory forbearance, we do not expect you to go invest in government paper. Of course, the banks will tell you, well, we're still trying to evaluate new loan applications, and as and when, and demand for loans are low, but as and when we get good pipeline deals, we're going to redeploy these investments into that. But we did make a good point, a point about that, and we kept our eye on it week by week. We also forbade them from paying dividends to their customers or making to their shareholders or making any manner of distributions to them. So that helped. But then the banks were somehow liquid as a result of the recapitalization we had asked them to go through by the beginning of last year. So the banks were sitting on a lot of capital, which then also made them pick up a lot of new government debt, because government was having to fund all these interventions, fiscal interventions, right, to provide relief to vulnerable groups. And as a few of the other panelists said, although we had the RCF from the IMF and the World Bank and the EU came through with a little bit of relief, that was not enough. So the government was having to borrow a lot. As Isabel said, you also saw massive capital outflows at the beginning of the year. In Q1, we saw investors begin to sell off their holdings in government paper. So the banking sector, again, going into the crisis much better capitalized than before, was also able to pick up this additional borrowing from government to be able to fund the reliefs that government was making. So the banking sector has really played that key anchor. Now, going forward, the real problem is, how do you ensure that this doesn't become a banking sector crisis? Through a number of channels, right? One being asset quality deteriorating, right? And we won't know, I keep saying, we won't know until the end of Q1 2021 just how bad the bank's financial health is. A lot of the moratoria they have given would expire by the end of Q1, March 2021. And that's when we're really going to know if these loans will become recoverable or not. And so that we're sitting on tenterhooks, if you will. So that's one channel. And then that would very quickly translate into liquidity problems and profitability problems and solvency problems in some cases. And then the government debt position is unsustainable in many respects, is getting unsustainable in many respects. And so you do have a real problem of, if government would have to restructure its debt, what would this mean for the balance sheets of the banks that have become the key anchors in the government debt market, right? And then you have the situation of how long would it take the real sector to recover? How long would it take the real sector to recover so that the banks get back to normal business, normal credits and all sorts of activities? And then you have the much smaller financial institutions. In Africa, you have very few large banks, and then you do have a lot of microfinance companies, savings and loans companies, cooperatives, and all of that. They are in a crisis, to be very honest with you. They deal with the bottom of the pyramid. Their customers, some of them have gone out of business, informal sector businesses and all of that. How are these going to be able to recover? And perhaps that's an opportunity also to review the business models of these smaller financial institutions, particularly in the advent of financial services that are conducted, powered by electronic transactions and all of that. There's a lot of work that needs to be done in providing the infrastructure and the policy and regulatory framework so that there's real partnerships between these smaller financial institutions and fintechs and other payment service providers through innovative financial services that allows them to operate not in the way that they've done, but in a really innovative manner to promote more access to finance in a way that's sustainable in the medium to long term. And then while we're doing that, let's be careful of strengthening the social safety nets, strengthening the financial safety nets in preparedness for what if this happens again, or something of this nature happens again in the next 50 years? How more resilient are we going to be as financial systems, as economies in Africa? So we need to start working on that even now. Thank you.
Thank you very much, Deputy Governor. This is a lot to very, very insightful and very interesting elaborated answer, and I appreciate that. And there's a lot to digest. And perhaps we can touch on some of the points you've mentioned in the Q&A that you have mentioned. First, I'd like to now pass it on to Deputy Governor Michael, and perhaps we could hear your perspective on this question. I know that you have been particularly looking a lot on applying policies that would make sure that credit are being directed to the sectors that are most affected by the COVID crisis. It would be good to hear from you in terms of what measures are you thinking? And I know you've applied a lot of interest rates. Has this been trickled down to the real sector? And if not, what new instruments or policies are being thought about?
Thank you for that question. And I think before I answer it, I need to give you the macro picture that is underpinning interest rates in the country. You know, unlike in the case of Ghana, which I had Elsie talk about, that as a result of this released liquidity, commercial banks were not allowed to invest in government securities. It was the kind of opposite in Uganda, because the issue was that the widening fiscal deficit that was resulting from the pandemic as a result of low revenues and then growing expenditures to deal with the pandemic, the fiscal deficit widened and there was need to finance the deficit. And the most immediate and available source of financing was domestic financing. So what we saw was that government upped up the issuance of domestic debt, and given the liquidity that the commercial banks had, they bought into that debt, and that's how government was able to get some resources. Now, that has continued, right? The appetite has increased. Net domestic financing has picked up. Now, certainly in that situation, you have the interest rates on government securities picking up. So we cannot be talking about whether the rates can be lowered at this moment, because if the risk-free instrument, which is the government security, is being impacted by the higher net domestic financing and the rates are going up, certainly the pricing for other assets that the banks are creating, like private sector credit, whenever they extend it, right, is likely to mark up on the risk-free rate. And so that means that any attempt that you have in terms of lowering the rates may not really work out. Notwithstanding the fact that the central bank has provided liquidity support, but we saw earlier on that banks are not drawing on that because they're risk averse. So the situation is not really playing out very well. So in terms of the micro, small, medium enterprises, right? How then have we managed it? You know, it's quite interesting that if you look at the average lending rates, I will just tell you the facility that is run by the central bank. If you look at the average lending rates in the banking system, it is anywhere between 15 and 21, 22% per annum, depending on your perceived riskness. If you are a good borrower, maybe you can end up about 15, all right? But the lending rate for small, medium enterprises, particularly to agriculture, in the facility that is handled by the central bank, is about 10 to 12% lower than the market rate. And how is that possible? It's because government has provided a resource, a grant, right? This grant, right, is for on lending, and government contributes 50% of that, and the participating financial institutions price their contribution as per the market, all right? So on average, all right, you have been able to lower, all right, the interest rates because government is providing a zero-rated interest component for on lending, and the commercial banks are charging whatever market rate it is for that component. So on average, the rate is lower than what would have already been charged. Then the beauty about the facility is that commercial banks are pledging collateral since they're the ones who are administering the loan, to ensure the performance of the loan, because you don't want to ride on government, right? If the loan doesn't perform, you lose your collateral. So two things are happening. One, the lower interest rates are being realized by the borrowers. And two, because of the enforcement, because of the follow-ups that commercial banks are undertaking on these borrowers, given the fact that they have pledged collateral, right, with the central bank, the recovery rates have been phenomenal, right? The average NPL of the banking system prior to COVID was under 5%. With COVID, it's slightly going up. But for this facility, right, the NPL before COVID was about 1%, and with COVID, it is edged up to about 1.9%, right? So overall, it's been a success in terms of reaching the micro, small, medium enterprises in agriculture. In terms of the interest rate, it's been much lower. In terms of the asset quality, is much better. And because of the refinancing flows that are coming from this, we are now able to generate more. So what am I trying to say? For every 1 unit of currency the government has put into this facility, as a result of the reflows, we've been able to generate an additional unit of currency for on lending, right? So as a result of government investment, we are doubling the amount of credit that is being extended to the micro, small, medium. So it is some kind of innovation that has helped address these chaps who would have otherwise been badly hit by COVID-19. And because the thing is targeted, is performing, you find that the impact in terms of ameliorating the income inequality and the unemployment that would have resulted from COVID-19 has to a large extent been mitigated by the beneficiaries of this facility. But having said that, what is the overall impact on the banking sector for these credit relief measures? I think if you ask me, has it been successful? I would want to say yes, but with lots of caveats. Yes, with caveats, because the response from the real sector has been muted. The real sector has not really benefited from these measures, right? The commercial banks have not extended more credit. So successful, the original intention was to support the real sector. Has it happened? Not that much. And why hasn't happened? Maybe we need to fully internalize, the commercial bank need to fully internalize what these policy measures are, what are the supervisory approaches, including the use of the buffers to support lending and loss absorption. We are not sure the banks have fully internalized that before they can begin extending more credit. And then also, we are laying so much emphasis that we need to collect more data, all right, to undertake stress tests, scenario analysis, in order to inform policy going forward, especially for some policy interventions, all right, even before we think of unwinding. So we need to find out that to what extent has this been successful, and you need really high quality data to be able to assess this. And then I think the issue of forward-looking supervision approach becomes very, very important in light of the ever-changing circumstances. There's need to evaluate the risk that the financial sector faces and determine the priorities for the supervisory actions that need to be taken going forward. So what are we doing to date? So the stress testing that we are undertaking now is to determine whether the supervised financial institutions, provisions and capital buffers, because let me back off here. The credit relief measures as indicated by ELSI, all right, are time bound. Most of them are ending in Q1. But within this period, there were some borrowers who opted for a shorter period of 3 months, 4 months. But the experience of those has really informed us going forward that when this matured, not all those who were able to fully continue servicing their loans. The number of those who have fallen back again all right, is quite worrying. So we have used that information to extrapolate what is going to happen, all right, at the end of this time-bound period, at the end of Q1. And it's quite interesting that the numbers that we're getting, including the scenario analysis, is calling us to begin thinking seriously that come the end of Q1 2021, if this pandemic has not really released the real sector activities, we are going to face a significant problem. And the question is, do commercial banks have sufficient buffers to continue with the credit relief measures? So what we're doing right now is we are asking all the supervised financial institutions to do what we call the internal capital adequacy assessment process, right? To find out whether their capacity to make provisions to cater for potential deterioration in asset quality is sufficient enough. And we need to begin having discussions with the commercial banks that if they're not sufficient enough, what is the way forward? You'll find that some of the big banks can absorb the capital, I mean the losses from the capitals, but there's some smaller banks that are tinkering at the margin of minimum capital adequacy requirements. And so the challenge is, what do you do with those, right? And what do you do with the non-banking financial institutions? I don't know the case in other countries, but we are seeing much more vulnerabilities and risks in the credit institutions because the capacity of the central bank measures to deal with the credit institution and micro deposit institutions are not as robust as we're seeing in the formal banking sector. So the challenges that we need to begin thinking now, and I would want to hear from the participants of this discussion that if this pandemic continues and is not releasing the real sector, how much longer can the commercial banks, can the financial institutions continue to provide credit relief measures without significantly affecting their buffers, all right, their capital buffers? I know we can argue that banks are well capitalized, but while they're well capitalized, there are many risks that this bank face, all right? For example, the volatility of asset prices. Maybe that huge buffer is to guard against the volatility in asset prices, volatility in economic activity. So are we going to argue that is sufficient? Maybe not. So I just want to leave it there. And I had a lot to say on the way forward, particularly in terms of financial institutions and technology, fintechs, and all that. But if time allows, I can get back to that. But to me, that is one thing that we really need to exploit as a way forward, because the business processes, the business models for the supervised financial institutions are going to be governed based on how the financial institution collaborate with the technology going forward as a solution. I thank you.
Thank you very much, Deputy Governor. This is indeed very, very insightful. And on the last part that you mentioned on the capital adequacy assessment process, I mean, we will dig further into that in the next session on responding to banking regulation and supervision challenges, looking at, of course, the issue of deterioration of asset quality, and really coupled with that is how can we think about extending credit relief measures, given that we need to maintain these financial buffers. And I also appreciate sharing with us some of the innovative measures that the government, together with the central bank, have taken on a government facility, and also on the remarkable NPL ratio. But of course, it's a continued challenge, as you have mentioned. I would perhaps, before we're getting quite a number of questions, but I do want to get through some follow-up questions, perhaps very quickly to you, Judith. So I'd like to get your perspective on how COVID changed the financial sector landscape. And as you do, perhaps if you can point maybe to 2 or 3 areas that we really should be paying attention to. We've heard a lot of them actually previously. But particularly on the role of financial sector, not only to support the recovery process, but also to support this structural transformation needs for Africa. So, to you, please.
Thank you. Maybe I can just respond a bit to Elsie's remarks. She commented about the the strength of the banking sector and the fact that before the when the crisis struck, it's in a much more robust state than it was 10 years ago. And I think I'd absolutely reiterate that. In many ways, it's been a big success story for financial regulation, of course, globally, but also in the region. The implementation of Basel III, capital strengthening. We've seen regulators. The capacity of regulators being really has been built over the last decade, and I think the fact that we've seen a effect on the banking sector could have been a whole lot worse. It could have been a fully fledged systemic crisis, and it hasn't been, and that's an enormous achievement really for the region, and will help economic growth going forward. So I think we need to recognise that. In terms of what we could do going forward, let me respond to one of the remarks. Someone asked about the asset management asset management company. This, of course, is an idea that's been used repeatedly elsewhere, where a company is or a separate entity is set up and bad assets are transferred into it. Now, normally that's financed by the public sector, but assets are typically bought at market rates. So, there's no subsidy to the financial sector. But the big advantage that it has is it clears the bad debts from the commercial sector and allows banks to be sort of relieved of the debt management problem and hopefully to reignite lending. And where that's been used before, it has been quite effective, particularly in accelerating a return to growth in credit in economies. And so that's something that certainly should be considered. We have seen a couple of examples of that in, for example, Nigeria. It's worked pretty well. But I think, you do need a high level of regulatory and government capacity to do it. But as we noted, that's probably not such an issue today in Africa, and it's something where it might be at the top of policy priorities. Let me pick up to just some of the other questions around structural transformation. Might mention the difficulties, the sort of longer term difficulties of financing the agricultural sector. We've also seen, chronic underfinancing of industrialization of manufacturing in the region generally. And I think that we do need to think going forward about how those things can be addressed. The dedicated facility that Mike mentioned, of course, is a great example. The African Development Bank themselves, of course, has been very active in closing gaps in sectors of importance for transformation, but that are underfinanced from the commercial sector. But I think it would also be something where we'd like to see innovation in private finance to crowd more, either through blended finance or through funds, dedicated funds, particularly with investors. Such as socially responsible investors who are interested in these kind of dual bottom lines. So those might be some of the things we might be thinking of. Let me finish there.
Thank you very much, Judith. Finally, Isabel, you sit in this unique position. You represent TCX, which works to protect foreign currency risk. A few weeks back, we heard in the Finance in Commons conference a renewed focus on the importance of development banks and multilaterals, also national development banks, who are really posed to play a very important role to dampen the negative effects of COVID-19. Given the demand of increased local currency support from DFIs and other development banks, how do you see your role in supporting DFIs in this post-recovery process? Post-COVID.
For sure. Thank you for that. First, I would like just to mention a bit to add to what Michael said. I think it's very impressive on Elsie's side to see that all the measure from the central bank trickle down to the financial sector, will trickle down into the economy, because usually when you provide liquidity to financial sector, it doesn't mean that they're going to take the credit risk. So it's kind of impressive to see that the financial sector in Ghana took the risk of taking the credit risk and whatever consequences it might have in the future to support the economy. We don't see that in other part of the region or even in other part of the world. That's usually a main issue. So on that side, I think it's what Michael has done in Uganda. I think it's great in kind of trying to make sure that the real sector continue to work. And one of the elements that has to be done on that side, I think, is the central bank taking the leadership all the time in setting up the right framework to push. So tier 1 banks will continue to do what they do, but I think there should be a strengthening of tier 2 banks, because there is clearly not enough bank. So the tier 2 bank should be strengthened. Microfinance institution should be maintained, because you need to take care of the bottom of the pyramid, and fintech needs to be promoted, because what I think we saw is that digitalization is key we saw a lot of digital company now being in the supply chain sector, financial sector, growing exponentially because they deliver a clear solution, especially that's so that at the head of the COVID crisis. And for that kind of the right regulatory environment in the fintech sector to allow intra-regional transfer, remittances to be easily retransferred, and kind of also, as Michael mentioned, putting a framework that encourage this fintech to work where tier 2 bank, tier 2 1, to increase the digitalization, working together to increase this ecosystem, it's key. On the side of the DFIs, I think there was the finance in common, as you mentioned, and the need for the development sector to work in collaboration, not always competing with each other, but work in collaboration to solve problem. And I think usually that's more structure on the sectorial basis, energy sector, agriculture sector, and also one element in financial market development. One of the elements in finance in common is that a push, at least on our side, we push a lot on financial market development, because for a resilient growth, there will be a moment when there is a need for a deeper financial sector, a financial market sector, to absorb some of the, because there will be a next crisis, there will be capital outflow. But if you have a deeper financial market, the crisis will be less strong. And on the local currency is the idea that we saw depreciation of currencies during this crisis, 20%, 15%, default due to that. And if there is a better currency mismatch, if there is less currency mismatch, that will allow to have a more resilient, more sustainable debt structure that will allow country at the macro level to manage better, and that will also have an impact in protecting the macro level. So I think if you think about what the financial sector landscape change and how DFI can help, digitalization, better risk framework, all playing the role of building the ecosystem for growth. And where DFI can help is usually what they did, act as counter-cyclical investor when everybody's leaving, to go back in, all in, full in. Also to help in pushing some sector development where the country can focus on private sector and financial market development and other element, and also providing element of risk management enhancement. The credit risk is an issue, counterparty risk is an issue. That's where I think development sector can play a role in providing all these blended finance, as you already mentioned, to kind of bridge the gap that facilitate private investor flow, that longer term maturity investment flows, and sustainable growth.
Great, thank you very much. I do have a lot of questions myself, but I really have to go to the audience. We're getting quite a number of questions, so and I'm very conscious of time as well. So what we'll try to do is I'll try to group some of these questions and see if, let's try it this way. So perhaps maybe for you, Deputy Governor Elsie, there's a question from Hannington on how did the Bank of Ghana affect reduction of interest rates during the lockdown period, given that reduction rates through the central banks is very sticky downwards and takes long to be reflected actually in the lending rates in the real sector. And this is something you've already touched upon. And maybe also for you, Deputy Governor, there was a question and comment from Eric Monchu. The Bank of Ghana did an excellent job in strengthening the banking sector, yet GHS depreciation by about 14% against the Ghana cedis depreciated by about 14% against the USD dollar. Was this a deliberate policy by the Bank of Ghana, or is it something being done to stabilize the local currency? Perhaps let me try to maybe, there's a question, I will probably address it to you, Deputy Governor Michael. We've talked about, you've talked a lot about the, well, actually Deputy Governor Elsie also talked about the increase in deposits in the banking sector. If that is the case, is that the case in Uganda as well? And if it is true, what was this attributed to? And perhaps maybe on the capital market side, we have seen an increase in savings in mutual funds, which we attributed to capital preservation, protection, and a lot of increased risk of deploying savings into the real economy. So perhaps a question on the increase of savings, and has that was that seen in Uganda as well? And then perhaps also for you, Michael, the Deputy Governor Michael, on the importance of digital finance. You wanted to touch on that a little bit. So there is a question on where do you see digital finance going in terms of regulation and policy, given the enhanced momentum during the pandemic. I'll stop there, and then maybe after that, I'll turn into the questions to the other panelists. So perhaps we'll hear from you, Deputy Governor Elsie.
Sure, thank you very much. So to the question on lending rates, yes, we did cut policy rate by 150 basis points. The banks almost immediately translated that into a reduction in lending rates, even for existing loans. Now that doesn't come naturally to commercial banks. So the banks in Ghana are not super stars in that sense. What we did was immediately call a meeting with the banking sector, with the CEOs of the banks, of the commercial banks, sat in a room with them and explained to them the reason why we had provided these reliefs, not only the policy rate cut, but as well as all the reductions in the liquidity requirements, as well as the capital buffers and all of that stuff. And it was almost a moral suasion at work to say, you're going to translate these to the banks, right? And to your customers. We need you to go yourselves, look at all of your lending rates and see how best you can immediately transmit these, as well as provide moratoria and other restructuring of loans for your customers. And the banks immediately, they were super. But again, the banks were in a better position. They had a lot of capital buffers, haven't gone through a major recapitalization exercise, and we haven't closed insolvent and severely distressed banks. So they were in a position to very quickly translate those into their rates because of our nudge, because of our moral suasion, and because they realized that the nation was in crisis, and that was their role in helping to do things. So they very quickly did that. That also, I'll tie that also in with I think there was a question on why, on how the banks continued to grant loans, even though it was risky. The banks were not on a lending spree. In any event, demand for loans was almost zero. However, there was a big demand for loans for industries that were at the forefront of helping to fight the pandemic. These were local pharmaceutical companies, as well as the textiles and garments industry that were beginning to make nose masks, for example. So the government had commissioned a lot of these textile and garments companies to do a mass production of nose masks. And there was then a huge demand for loans for those industries. So it was very targeted. And then very quickly also, I think this is a point Michael had made, the capital and liquidity buffers that were released to the banks, they were not supposed to invest in government paper. However, a lot of their deposits, they got very high deposits from their customers, not only because there were new deposits coming in, but the fact that the customers were not withdrawing deposits. People were not spending. So there were no weddings, there were no parties, people were not traveling. So really, a lot of the deposits stayed in the banking sector. And then even new deposits were going into the banking sector because people were just not spending. And so this allowed the banks to then also channel additional liquidity they had, not from the reliefs we had given them, but additional liquidity they had into government paper. Because I said there was a substitution with the investor outflows, the banking sector and the pensions industry stepped up to then pick up additional government borrowing. But that didn't come from the reliefs we had provided them because that we're very strict about that. And even when they did, it was on very short-term paper. So these are some of the measures we took in place. The banks traditionally won't want to take any risks or won't want to translate these reliefs into reliefs for customers, but we did engage with them. And on a weekly basis, our supervision department was in touch with them, looking at their books, looking at their data to see, what are you doing with these reliefs? What are you doing with this? What are you doing with that? We don't want it to become imprudent in lending, but for as long as there's good demand for loans for industries that are at the forefront of helping to fight this, we needed to fund them, by following your usual credit underwriting processes, but please do fund these. And So that it became a partnership between the central bank and these banks. You know, like I said, the challenge really going forward is when these measures are unwound, at some point we're going to have to roll back our forbearance, right? And the banks themselves are going to be in a situation to realize how many of these loans they provided will be paid or not, or how many of these moratoria was necessary and all of that. But it's one day at a time, and we're having a different set of conversations around that going forward.
Thank you very much, Deputy Governor.
There was a question, AK, about depreciation. Let me touch on this very quickly. So yes, we did have a lot of depreciation last year, but it wasn't peculiar to Ghana. It was really an emerging market phenomenon. And even within the emerging markets, Ghana did considerably well, but there was about 2 or 3 major episodes of currency depreciations last year in the emerging markets. So Ghana's cedi was really part of that phenomenon. This year, the cedi depreciation has been less than 4%. And let me also add that we don't target a specific exchange rate. We're an inflation targeting country. And so we look more at inflation, but we do intervene in the foreign exchange market from time to time to smoothen out excess volatility and to make sure there's sufficient liquidity, FX liquidity for investors, for example, who need to repatriate the investments out of the country. But we don't target any particular rate, any particular exchange rate. So I do hope that that is helpful to the questioner. Thank you.
Thank you very much, Deputy Governor Elsie. Deputy Governor Michael, do you want to touch on the increase in deposits? You've already talked about that. And there's also the question on digital finance and how do you think that will play a role?
Thank you so much. I'll just say something briefly about the increase in the deposits. I think what actually explains the increase in the deposits in Uganda is the fact that our government decided to give some fiscal support to deal with the COVID-19. And one of these measures was the repayment of domestic arrears, all right? So to the extent that government had increased borrowing from the domestic financial system, mainly banks, coming out of the liquidity and the capital buffer that have been released, we see increased holding of government securities that went towards arrears payments, all right? And so these guys who had been holding on to government for money all of a sudden got increase in money, all right? So they deposited in the commercial banking system. But again, because banks were risk averse about lending out to the private sector, what happens? The deposits just continue to grow. And so it is basically a fiscal impact of domestic arrears repayment to support the private sector. Now, on the digital aspect, I think, like in most countries, all right, I think it was observed that the use of currency, notes and coins was one of the avenues where this virus was being easily spread. So the uptick in the use of e-payments was noticed world over, all right, particularly in countries that had not been using it before. So we see a significant jump in e-payments. Now, we then said, look, it's actually possible to continue with this path, because now what most banks did and what most of these mobile money companies did was that they embraced it, and so did the population embrace it, and more so, government also reduced some of the taxes it had put on, all right, for these mobile money transactions. So a combination of so many factors really led to a jump into the use of e-money. Now, the question for us going forward is, how do we sustain this? How do we ensure that we don't go back into the use of the currency, even after the vaccine is discovered and it's distributed? How do we ensure that? So I think now we are out to highlight the benefits of using e-payments. So the partnerships between financial institutions and technology firms are being encouraged, to go into this area. And then the other thing that is really bothering us now is we are seeing that even this cyber, the fraudsters also are upping up their game, all right? So the whole aspect of cybersecurity is now what we're dealing with. So as a result of that, we recently passed the National Payment Systems Law and implementing regulations, all right, to support it. And some of those regulations are really dealing with innovation, things like regulatory sandboxes, consumer protection, and what have you, all those regulations that are geared towards supporting the use of this, but more so cybersecurity, because if you have cybersecurity around, you cannot grow your e-payment. So this is what we're working with. So we know that the system can only be secure, all right? It can be as strong as the weakest link. So now in terms of our regulations, we are trying to ensure that all those chaps who are part of this ecosystem, digital financial ecosystems, have to implement some minimum cybersecurity standards that ensure the safety of the whole thing. So we've been having some aggregators, some integrators who have not been regulated at all. And these have been the weakest spots, right? And the fraudsters have actually penetrated even some of the institutions with strong cybersecurity mechanisms through these integrators and aggregators, because they are the weakest link. So going forward, we want to ensure that everybody in the digital financial system is observing some minimum cybersecurity standards to cut off these fraudsters. And then, of course, in terms of the business continuity, this digitalization has taught us a lot. And we see that the employees in the financial sector continue to work remotely, all right, using this technology. And most of the SFIs have now accelerated the rollout of digital projects. So what does this mean for supervision and regulation going forward? How are we going to up our game in SupTech, in RegTech, and in ComTech? Right? What does it mean for us going forward? So I think that's where the challenges are. But we need to cooperate. We need to continue focusing on technology, both as a tool to facilitate regulatory compliance and strengthening, of course, cyber and cyber data security, including the identification of the chap. Because one of the key challenges that we're facing is identity. All right, so we need to enhance the identification of the users of the system. That's one way to deal with the fraudsters as well. But of course, there are other things like infrastructure. How do we ensure that we have sufficient infrastructure to encourage the growth of this? Do we have a sufficient legal framework to support this going forward? And then even upskilling, all right? I mean, we need to change our own syllabuses, all right, to lay more emphasis on science, technology, engineering, and mathematics. You need mathematics, all right, to be able to train chaps to do algorithms, right, for developing of these apps, all right? So that specialized, education, STEM, all right, going forward. And then sensitizing the public on the use of this e-money is very, very important, all right? Very important. As a central bank, the cost of printing currency is impacting on our balance sheet. And we in an environment where our income from the reserves is dwindling, we need to see where to cut costs from. And one of the biggest costs that we can cut is currency printing by encouraging a move into e-payments. So we are being forced to do that. And then, of course, I talk about cybersecurity. And there's a lot that we can talk around that, but time is not on our side, so I'll leave it there.
Thank you very much, Deputy Governor. And I'm glad you mentioned cybersecurity, because this is an area we're paying close attention to, and particularly looking at different solutions like a national, probably a resource center, a shared resource center that could be shared at the regional, sub-regional level. Very mindful of time, and if the organizers permit me, I'll probably just end this panel with one last question. It's going to be an open question to all the panelists. Probably just in a minute, if you can give me your thoughts. The question is on, has the crisis demonstrated the importance role of the financial sector as the lifeblood of the economy? So I thought it's a very thought-provoking question, and I'll start maybe with you, Judith, and then Isabel, and then we'll end with Deputy Governor Elsie and Michael.
Okay, I'll be very quick in the interest of time. I'd say absolutely yes, but I think not only the lifeblood economy is quite general, but also what the financial system can do for the economy in these kind of crisis situations, in terms of supporting the real economy and being, providing an important pro-cyclical and counter-cyclical role. So, yes, absolutely. But we also need to keep the financial system sound and stable for it to fulfill those functions.
Thank you very much. Isabel?
Absolutely. I think it was always the case. We saw that through some different crises. I think one of the important elements after making that statement is it's key to strengthen the ecosystem. And I think that's where central bank have a leadership role to play to make sure that all the actors in the financial sector talk to each other, collaborate to each other to bring a strong ecosystem, a strong infrastructure for growth. And looking at the different elements being financial markets development, digitalization, all these elements that will ensure that the economy is strong. And because once the financial ecosystem is strong, then all is kind of the heart, everything flow around in the economy and make sure that it flows around in the economy, obviously.
Thank you very much, Isabel. Deputy Governor Elsie?
Thank you very much. Yes, my answer would be yes, as I've shown in the case of Ghana, but that also presupposes that the financial sector itself is standing strong. Otherwise, it becomes a problem, or it becomes part of the problem. So that has implications for me in terms of going forward. How do we continue to build our financial systems? How do we ensure that they are not only safe and sound, but they are also inclusive and also sustainable going forward? And so often policymakers and regulators see conflicts in some of these major policy objectives. Sometimes you might have trade-offs between stability and inclusion, as well as integrity when it comes to AML, CFT rules and all of that. Sometimes they would push out certain elements from the financial system. So how do you really balance these sometimes competing objectives? I don't see them as conflicting. I just see them as complementary of each other, but that requires some very careful design. There are lots of opportunities we have in this pandemic to build better backwards, as they say. And in doing that, we need to be very intentional to design our safety nets, our financial sector safety nets, to ensure that they're more resilient for the future through financial systems that are built with strong infrastructure, not only in terms of policy and regulatory regimes, but the kinds of market infrastructure to ensure that there's credit available in sustainable ways. We're able to tap into green finance markets around the world, and we're able to bring everyone along on this journey for inclusive growth. Thank you.
Thank you very much. And finally, Deputy Governor Michael, last words.
Yeah, thank you very much. I totally agree with Judith in that the financial sector has been a lifeblood, because we've seen that it can be used to address the issue of cyclicality, all right? And this has been possible by ensuring that there's increased flexibility on the part of the regulators through the judicious use of flexibility embedded in the regulations. How do you apply these buffers, liquidity and capital buffers, to address a business cycle that you're facing? But much more importantly, going forward, all right, if we have to ensure that the financial sector becomes a lifeblood, it has got to ensure that financial inclusion, all right, is pursued going forward, so that you bring all these guys who are currently financially excluded to benefit from the lifeblood that we're talking about. And I want to believe that increased use of technology is one way that we can crowd in these guys who are currently excluded so that they can benefit. So the challenge is, how can we work together, central banks as our partners out there, to ensure that increased financial inclusion through the use of technology is actually made possible.
Right, thank you very much. On this note, we unfortunately have to bring this panel discussion to an end. It's been a very fascinating discussion, and I want to especially thank our speakers today, Deputy Governors Elsie and Michael, Isabel and Judith, for your very insightful and really thought-provoking contributions. I also want to thank all the participants who have joined us today and submitted your questions. Please stay tuned. So this is we're just only getting started. And for the next session at 11 a.m. Abidjan time, we will be discussing responding to banking regulation and supervision challenges during the global pandemic. Thank you all very much, and I wish you all a very good day, and stay safe and healthy. Goodbye.
Thank you.
Thank you. Bye.